Are you able to qualify for a DSCR loan? Welcome to part 10 of our DSCR loans video guide series, where we go over everything you need to know about how to qualify for a DSCR loan for your rental property, specifically the borrower requirements. Now, wait a second. Aren't DSCR loans based on the property's cash flow, not the borrower? Yes, but despite the myths, these are not no-doc or property-only loans. There are specific borrower and guarantor requirements you must meet qualifying for a DSCR loan. Borrower requirements for qualification. DSCR loans are tailored for real estate investors, but that's a broad category. There are both borrower qualification requirements and property qualification requirements when it comes to eligibility for a DSCR loan. In this video, we'll look at the borrower side of the equation, which, despite common misconceptions, plays a significant role in DSCR loan qualification. These are far from property-only or asset-based loans. What is the typical borrower profile for a DSCR loan? The classic DSCR loan borrower is someone who invests in residential real estate for the purpose of building wealth and cash flow and plans to hold their properties as rentals for the medium or long term, 5 or more years typically. This could range from a full-time investor with dozens of doors to a part-timer with a handful of rentals. Many DSCR borrowers fall into the category of having multiple properties, say 50 to 50 units in their portfolio, and are looking to scale up further. Often, they've hit a wall with conventional financing or just prefer the ease of DSCR loans to keep acquiring properties more rapidly. The 5 to 50 properties, or doors in industry parlance, rule of thumb, describes many investors who utilize DSCR loans for some or all of their financing. Residential real estate investors with fewer than 5 properties can and certainly do utilize DSCR loans. However, many still qualify for conventional or bank options at that portfolio size, and many times conventional loans may be the better fit. Additionally, a conventional loan hassle and paperwork, as well as qualifying difficulty, tends to be cumulative in nature. That is, for each additional property added to the portfolio, the level of challenge to qualify as well as the overall process complexity snowballs and grows with each loan. It's common for investors to hit a wall around the 5 property mark, where they are ready to keep scaling but hit snags or delays in qualifying with the previously used conventional or bank options, which tend to use DTI ratios requiring conservative estimates of revenues and aggressive uses of expenses, or these borrowers simply get tired of the documentation demands that run in the way of scaling. Around property number 5, again, this is just a rule of thumb, many investors hit this mark earlier or later in their wealth building journey. The pros of DSCR loans, easier qualification, less burdensome documentation and process, tend to outweigh the cons. Generally, these are a bit higher in rate and fees. On the other end of the spectrum, DSCR loans tend to not be a fit with investors, or more commonly in this range, invest in groups and companies with 50 or more properties. This level of portfolio typically allows access to institutional grade financing with the enhanced access to capital markets available only to larger financial institutions and very high net worth individuals. DSCR loans are really intended to be a financing option for individual investors or small groups, although exceptions do exist, particularly in the case of short-term rentals, where as of today, the still somewhat nascent industry lacks institutional financing opportunities, even for larger companies and funds. While DSCR loans can still work for borrowers with property portfolios in excess of 50 and even past 100 units, once that level of portfolio is reached, the best advice may be to stop buying, enjoy your financial freedom, and go relax on the beach or a yacht. Let's talk about an important distinction next: borrower versus guarantor or sponsor on DSCR loans. An important nuance when it comes to DSCR loans is the difference between synonymous terms that nevertheless have meaningful and impactful distinctions and differences. One example of an important terminology and language distinction when it comes to DSCR loans is the specific definition of borrower. For DSCR loans, the borrower represents the actual borrowing entity, or who the title is vested to. This is the named party that shows up on the legal documents, the note, the deed, etc., as well as other important documents such as the appraisal and insurance policy. Title vesting means who actually owns the property. and this owner can be an individual person or persons or a legal business entity. For many DSCR loans, the specific borrower is an entity, typically an LLC, as investors tend to see vesting title this way as one of the many pros and advantages of DSCR financing. This is because the structure allows enhanced legal protections and the ability to invest alongside partners for optimal outcomes. However, it's important to note that DSCR loans are what's known as recourse loans, where even if the borrower is an entity like an LLC, an individual or individuals, typically owners with at least 25% in the LLC, must sign a guarantee document which ties the debt to an individual person who is liable to pay back any defaulted lender losses not covered through the foreclosure process. The DSCR loan qualification process involves evaluating the guarantor, or sometimes called the sponsor, rather than any entity like an LLC that may be the technical borrower on the loan. This means that non-property-based aspects of the DSCR loan underwriting process, such as credit score, background checks, experience, and liquid assets, are based on the guarantor or sponsor, or guarantors and sponsors, rather than the borrower, in the case where the borrower is an entity. A recourse guarantee means that in case of default, and after the property is foreclosed upon by the lender, the amount owed to the lender, including loan balance, accrued interest, and fees, plus costs associated with foreclosing, such as legal costs, maintaining and prepping the property for sale, etc., exceeds the proceeds from the sale. Then the lender can go after the personal financial assets of the individual guarantor or guarantors for the shortfall, the difference between the foreclosure proceeds and the remaining balance owed. But rest assured, this is a very rare occurrence for DSCR loans, as the vast majority of loans don't default. However, for DSCR loans that do foreclose, it is typically the case that the foreclosure proceeds can comfortably exceed the balance of what is owed even then. However, sponsor or guarantor qualification and underwriting is still a meaningful part of DSCR loans and crucial for the well-informed investor to understand. For DSCR loans made to an LLC, which members are required to personally guarantee the loan? Well, in most cases, DSCR lenders will require individuals of an entity, such as an LLC with 25% or greater ownership, to be full recourse guarantors of the loan. DSCR loan underwriting will entail running a credit report and full evaluation and qualification measures of such individuals, such as mortgage rates, credit events, etc. In addition to each owner with 25% or greater ownership, usually, but not always, an aggregate ownership of at least 50% of the owners of the LLC must be full guarantors. This means, for example, if the ownership structure of an LLC borrower is 40%, 20%, 20%, 20% structure among 4 owners, at least one of the 20% owners must also be a guarantor, since even though only one sponsor exceeds that 25% threshold, the one that owns 40%, in aggregate, at least 50% of the LLC ownership needs to usually provide guarantees, and the 40% owner by themselves falls short of the threshold in this example. However, as of 2026, it is important to understand that different DSCR lenders have different rules for this, and even within a specific DSCR lender like Harpoon Capital, different programs may exist with different rules, and things are becoming somewhat more lenient in this category. For example, there are some programs now that will only require one guarantor who owns less than 25%, even something like 20%, to be a guarantor. And even a majority owner or someone with over 25% can potentially not be a guarantor. For more information, check the description below or reach out to us at harpooncapital.com and we'll give you all the options. It's also important to note that DSCR loan recourse guarantees are joint and several, meaning that in case of recourse, each guarantor is separately and fully liable for the amount owed, meaning the lender can go after each individual separately for 100% of the balance owed, even if they're, for example, 50-50 owners. While this language distinction, borrower versus guarantor, can seem pedantic or not relevant, it can be very important in some DSCR loan scenarios, such as determining which owners of an LLC must sign guarantees, which credit score among multiple guarantors will be used to qualify, and even whether prepayment penalty provisions are allowed. This varies by state. Thus, while borrower and guarantor or sponsor are typically used interchangeably, both here and throughout the broader industry, it is important to note this distinction and understand the nuances and ramifications. Here's a common FAQ. Do DSCR loans show up on a personal credit report? DSCR loans only appear on personal credit reports only for borrowers that vest title or take the loan out in their own personal name. If the loan is taken out by an entity as the owner of the property and the borrower of the loan is an LLC, even if the entity is owned 100% by an individual, the DSCR loan should not show up on a personal credit report. That being said, sometimes there are errors by loan servicers where it will accidentally show. In these cases, it's important to call your lender and they can typically look into it and get it removed in time. Make sure to do this because not showing up on your personal credit report is an important pro for a lot of borrowers choosing DSCR loans. Another common FAQ we hear about a lot is experience. Question: can I get a DSCR loan as a first-time real estate investor? One of the most frequent and persistent misconceptions around DSCR loans are that they are no-doc or asset-based loans, but as this video guide explains, DSCR loans are neither no-doc nor asset-based. DSCR loans do have a robust and common-sense underwriting process, and the qualification does require certain hurdles for the borrower, or more specifically, as we've talked about, the guarantor or guarantors, to qualify. While qualifying credit score is easily the most important borrower factor for qualifying for and getting the best rate and terms for a DSCR loan, other factors such as liquid asset reserves, citizenship or immigration status, and experience do play a role in qualification as well. And the simple answer is yes. First-time investors can get DSCR loans from the vast majority of DSCR lenders. Some lenders can and do choose not to include first-time investor qualification options under their specific lending programs. Typically, first-time investors will be able to get access to all the same terms and options as experienced investors, albeit with some minor limits and restrictions. These limits and restrictions typically come in the form of lower LTV maximums, such as a maximum LTV of 75 instead of 80 as a standard limit, or minimum credit score, such as 680 instead of a general program minimum of 640 for experienced investors. Additionally, DSCR lenders will typically have a specific definition for first-time investor that differs from a plain text reading. In most cases, it will be defined as the borrower owning and managing a rental property for at least 1 year in the 3 years prior to the application date, or a similar concept. As part of the qualification process, the investor will likely have to document that experience to qualify as an experienced investor and avoid the first-time distinction and limits. This is an important nuance to note for investors, as unfortunately, some borrowers have been surprised to learn they fall into the first-time investor category when they have owned many properties in their life, but just more than 3 years prior to getting back in the game. Another important distinction regarding experience requirements to qualify for a DSCR loan is between first-time investors and first-time home buyers. While first-time investors can generally qualify for DSCR loans with most lenders, subject to those minor restrictions, first-time home buyers, or borrowers who have not recently owned any sort of residential real estate, even including a primary home, typically cannot qualify for a DSCR loan. Lenders understand that owning a residence comes with many learning experiences and responsibilities, and many investors use lessons from owning their first home or through house hacking to aid in operating their first investment property successfully. Unfortunately, for individuals wanting to dive into real estate investing before owning a primary residence themselves, DSCR loans are typically not an option. That being said, Harpoon Capital currently has a first-time home buyer DSCR loan option available. For more details, check the description below or reach out to us at harpooncapital.com. It's important to note that, like the distinctive definition of first-time investor for mortgage qualifying purposes, DSCR lenders use a similar definition, redefining first-time home buyer in this context to mean not owning a primary home in the last 3 years. While this may appear to be an overly cautious and unreasonable guideline, particularly for older investors who have owned their home for many years and downsized to renting a smaller home as empty nesters, for example, mortgage lenders are constantly on high alert for indications of mortgage fraud. A particular concern in this context is occupancy fraud, or when borrowers falsely attest that they plan to use a property for business purposes only to qualify for a DSCR loan, while secretly planning to occupy the property. The seemingly harsh restriction and definition of first-time home buyer first time meaning that they haven't owned in the last 3 years and instead of a true first time, likely exists as an anti-fraud measure that may inadvertently exclude well-qualified borrowers. By the way, if you want to see exactly what rate you qualify for right now, first timer or experienced vet, check out the link in our description to access our 10-minute web application. Next, let's talk about borrower status, U.S. citizens, visa holders, and foreign nationals. Who's eligible for a DSCR loan? When applying for a DSCR loan, an important factor is the legal residency status of the borrower or the guarantor, specifically whether they are a U.S. citizen, permanent or temporary visa holder, or a foreign national living abroad. Unlike conventional loans, which may follow strict rules around residency, DSCR loans tend to offer broader access, but the qualification standards vary depending on the investor's exact status. DSCR loans for U.S. citizens and permanent residents. For U.S. citizens and lawful permanent residents like green card holders, there are generally no added restrictions on DSCR loan eligibility. American citizens can qualify by providing a valid license and credit authorization with no further documentation to qualify needed. This status gives full access to all DSCR loan programs with the same maximum LTVs, minimum credit scores, and everything else Max program allows. For permanent resident aliens, full qualification and program access is also generally available for DSCR loans, with acceptable documentation such as the Alien Receipt Card I-551, or commonly referred to as a green card, or even a non-expired foreign passport that contains a non-expired stamp that's valid for a minimum of 3 years, reading Processed I-551 Temporary Evidence of Lawful Admission for Permanent Residents. DSCR loans for visa holders or non-permanent residents. Non-permanent resident aliens, meaning individuals temporarily residing in the U.S. under a valid employment-based visa or work authorization, are typically eligible for DSCR loans, but with some added qualification criteria and moderate program limits in some cases. That is, some DSCR lenders will not have any program limits for non-permanent resident aliens, and some will. Generally, non-permanent resident aliens will need to provide an unexpired resident visa that proves the investor's legal right to live and work in the United States. Non-permanent resident alien investors looking for a DSCR loan will need to have a full U.S. credit report and a visa that is not only not expired, but is valid for a significant amount of time post-closing date, typically ranging between 6 months to 3 or more years, depending on your DSCR lender. Many DSCR lenders will provide non-permanent resident aliens who qualify with these requirements full program access or standard LTV maximums, credit score minimums, etc., while some will include moderate restrictions, such as lower LTV maxes, restrictions on cash-out refinances, and some more stringent credit requirements. Additionally, some DSCR loan providers may have ethical standards against providing financing to investors falling in these categories, and thus crowding out opportunities for American-born aspiring investors, and will not provide loans to sponsors under non-permanent resident visas. DSCR loans for foreign nationals. For DSCR loans, the precise definition of foreign national is important and often a source of confusion. DSCR lenders define foreign nationals specifically as individuals who live and work in a foreign country and are legal residents of that same country. Note that this does not include individuals who are foreign citizens but are living in the United States under valid visa status, permanent or non-permanent. These people, while citizens of a foreign country, are not considered foreign nationals for DSCR loan purposes. There is significant industry differentiation when it comes to foreign national DSCR loan programs, as a sizable segment of DSCR lenders do not lend to foreign nationals. However, there are a subset of DSCR lenders that do offer DSCR loans to foreign nationals, often under a separate loan program with significant restrictions. For lenders that offer DSCR loans to foreign nationals, typically there will be significantly lower LTV maximums, such as 70% max for rate and term refinances and purchases, and even lower for cash-out refinances, or even potentially a total prohibition on cash-out refinances for foreign national borrowers totally. Other restrictions can include higher DSCR ratio minimums and potentially additional liquid asset reserve requirements. Probably the biggest wrinkle when it comes to DSCR loans for foreign nationals is evaluating credit, as many foreign nationals don't have U.S. credit reports, but in the absence of one, will still have to establish some sort of credit history to qualify. This can be accomplished by providing proof of several credit accounts with a couple years of activity, and of course, no significant credit blemishes. Documentation requirements include a foreign passport as well as proof of address abroad, and these guarantors must pass additional OFAC and background screenings, with many DSCR lenders following government guidance restricting financing to currently sanctioned or restricted countries. While almost all DSCR lenders will offer loans to permanent residents and non-permanent resident aliens alike, far fewer lenders will have foreign national eligibility. This is likely due to a variety of reasons, including the higher risk nature of lending to foreign nationals. It's much harder to utilize recourse even if a guarantee is signed, the increased complexity of documentation and compliance requirements, as well as the ethical and security problems of promoting foreign ownership of American real estate. Another FAQ break. I'm not a U.S. citizen. Can I qualify for a DSCR loan? The answer is yes, but it depends on your residency status. Non-permanent residents, such as visa holders with a valid work history, social security number, and authorization, are generally eligible, although some lenders apply minor restrictions like lower LTVs. Foreign nationals who live and work abroad may also qualify under specialized programs, but face tighter limits such as lower max LTVs, higher minimum DSCR ratios, and additional liquid asset reserve requirements. While most DSCR lenders serve green card holders and visa-based sponsors, only a smaller subset offer those true foreign national DSCR. Finally, let's tackle sponsor background checks, legal history, and compliance flags in DSCR loan qualification. DSCR lenders also usually conduct some sort of background check on the sponsor or guarantor to look for red flags that could signal risk or trigger disqualification. This includes checks for felony convictions, fraud, money laundering indicators, and other civil or criminal history that could create intolerable risk for the lender and eventual note holder. DSCR loan borrowers, guarantors, are normally subject to a third-party background screening, which is usually ordered early on in the qualification process. These background checks cover criminal history, including any felony convictions on the individual records, civil litigation records, which cover any judgments, bankruptcies, or pending lawsuits that might complicate personal finance and obligations, as well as public records, specifically monitoring for any evidence of mortgage or title fraud or any outstanding tax liens. Any felony convictions or pending charges involving mortgage or financial fraud is likely to result in DSCR loan ineligibility. Older offenses or unrelated convictions may be reviewed on a case-by-case basis depending on the lender's internal risk policy. Generally, convictions outside of crimes specifically related to financial or mortgage fraud, which are typically non-starters for qualification, won't preclude qualification if it happened a long time ago, such as 7 or more years, and you have a good letter of explanation provided that gives context to the issue and shows how the sponsor has changed for the better. In addition, DSCR loan background checks included OFAC screening. This is the Office of Foreign Assets Control, to ensure the borrower isn't from a sanctioned country or listed as a specially designated national, or SDN. Even though DSCR loans are typically offered by private lenders and fall outside the government-sponsored consumer mortgage regulatory framework, DSCR lenders must still comply with the U.S. Treasury Department rules and regulations around money lending. DSCR lenders also look for non-criminal but high-risk red flags that may not technically disqualify a sponsor, but can delay or complicate the process. These can include a pattern of litigation involving real estate disputes or investor lawsuits, a prior bar or suspension from working in regulated industries such as securities or mortgage lending, or involvement in ongoing legal proceedings that could result in a judgment or lien. In addition, many DSCR lenders will perform a Google or name search on the sponsor to check for media coverage or public records that suggest risky behavior. Something as simple as a news article about a real estate fraud ring, even if the investor wasn't convicted, can prompt extra scrutiny. For investors with a clean legal record and financial track record, this part of the process is invisible and uneventful. But if you have any prior issues that could raise red flags, even if they're older or not criminal, it's best to disclose early. Some DSCR lenders may be willing to issue exceptions if the sponsor can provide documentation, a letter of explanation, or proof of restitution. However, this is much more likely to be successful when the borrower is forthright and honest up front in the process. Ultimately, DSCR loans are low-rate, long-term mortgage loans on actively managed and operated rental real estate, and the lenders treat the sponsor as a key operator of the investment. A potential borrower who appears unstable, reckless, or high risk from a legal standpoint will almost certainly be declined, regardless of DSCR or LTV metrics, or even credit score. Finally, one last FAQ. Can I get a DSCR loan with a felony conviction on my record? The answer, possibly, but it depends on the nature and timing of the conviction. DSCR lenders will typically run background checks on guarantors and will deny loans for recent or serious financial crimes like fraud or money laundering. Older or unrelated felonies may be reviewed on a case-by-case basis. Disclose any issues early. Hiding it is the fastest way to be declined. And there you have it, the complete guide to DSCR loan qualification on the borrower side. While they are an amazing tool, every real estate journey has its hurdles. If you want to learn how to navigate DSCR loans like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. And don't forget to like this video, subscribe to our channel, and check the description below for all the links we mentioned today. Happy investing, and we'll see you in the next video, where we'll cover the financials aspect of borrower qualification for a DSCR loan, particularly everything you need to know about down payments and liquid asset reserves.